Hello everyone, welcome back, and this is a review of the fourth quarter 2025 and the outlook for this year. So how to plan for a portfolio? There are several ways, right? You can have defensive, you can have offensive stocks. Okay, generally it depends on your personality, whether you want income-based or you want something that's capital growth. If you are younger, you have a long horizon, generally go for capital growth. If not, go for defensive. But I also want to warn that beware of high dividend paying stocks and bonds. Generally, the return is about 6-7%. We have very good bond funds, historically about 6 to 7% return. So in this video, right, we talk about the problems of companies that overpay dividends or set a very high bar where their payout ratio is like 60-70% of their free cash flow that is being generated. The problem lies in once you pay so much, they could have taken the money to reinvest into the company. And, you know, if it's giving back to you, that means usually they are mature companies or growth has slowed down, they don't know what to do with the money. Take note, if a company, for example, if it generates $100 in free cash flow, they have a choice to reinvest that full $100 to actually generate $300 of profits the next year if they are good, or even $400. A very good company, good management can even, for every $1 reinvested into a company, can generate $2-3 worth of profit the next year, right? So just imagine that you are making curry puff or pizza parlor. You could have opened another restaurant and double your profits, but instead you take the money to pay off dividend. That means that you really don't know what to do. Maybe you think that the market is saturated. It is a signal, yeah. So high a dividend payout ratio is a problem. So generally, what the users of capital reinvest it so that it can grow even more cash for the company. And that's all there is to investing, right? You want to own a business that keep generating cash, and you think yourself as a shareholder or a business owner, right? And all else fails, if the stock is cheap, I would prefer that they buy back their own shares, because when you buy back their own shares at below the intrinsic value, you're giving a signal. And if you, as a shareholder, if you choose not to sell the shares, actually your earnings per share grow because your share count percentage, your share count might be the same, but the percentage has increased. Just be wary of that. Generally, even if you want to have any dividends of the company, the payout ratio should be 25% or less. Okay, next we look at the history of asset performers. A lot of investors ask me, why do I focus a lot on US? It's not really true, but there's a saying, I think it's by Charlie Munger, to fish where the fish is. Right, go to a pond where there's a lot of fish, your highest chance of doing it right. So the last 20 years, the performance of what are the asset classes that come out tops? S&P 500, 5 out of 20 years, 25% return of the time. They are actually the top performer. Okay, this is a history over the 20 years. Russell 2000, which is also US, okay, small cap, 4 out of 20 times, which is 20%. So together, US, big and small cap already account for 45% of the time. Not all the time, 45% of the time. Then emerging market accounts for 20% of the time. And then real estate global, which is REITs, it could be REITs, it's a global index, is 15% of the time, followed by US. Fixed income is 10%, cash is 10%. They say when you really want to hit the biggest pay dirt, almost half the time is US, and then yeah, I mean, 1 out of 10 years is emerging market, and then income producing assets like real estate. So I tend to focus a lot on US, but I'm very flexible. I can go to Japan, to China, to emerging markets, Asia, if we find quality business, right? So last year was a top performing. I think Japan had a good year, emerging markets had a good year, Asia had a good year. Question that we asked, what actually drives the stock market? Now, EGP growth does not equate to earnings per share or stock price performance. The problem in a lot of emerging countries, right, this is MSCI earnings per share. It hasn't gone up. The GDP has been flying through the roof, right? You're looking at 10% growth, 14% in the early 2000s to now about 8 7, and finally now 5%, GDP growth, the earnings per share doesn't translate to that. And over long term, beyond 1-2 years, stock price almost always follow earnings per share. So the secret outperforming the stock market is to keep finding companies that are able to generate earnings year after year, higher and higher earnings, and then you will make money from the stock. Okay. To wrap your head around it, if you buy a piece of business, let's say you take over a pizza parlor, back to the example of pizzas. Okay, we have European investors and listening, so chicken rice may not make sense. Yeah. So do you really care that the pizza parlor used to make $100,000 of net profit a year on the sales of 1 million? Do you really care? Yes, it matters. Okay, the last 5 years, we want to look at the earnings, the revenue, the sales, whether it has been growing, because it gives you an indication of the quality of the food, the location, the loyalty of the company, of the clients, right? The restaurant customers. Now, but when you buy, you decide what to buy. Well, the price that you set to buy depends on how the next 10 years, 5 years in perpetuity, what is this earnings going to be? If you think that it's going to be 100,000 this year, soon after you buy, it's going to be 150,000 profit, and then 200,000, 250. Why? Because pizza is going to be very popular. Yeah, of course, you're going to pay a lot for it, right? You're going to pay like maybe 15 times PE because it's growing at 20% per year. A lot of it is forward-looking. In fact, almost all of it. And the way to price a company is to look at the company, the business that you own in perpetuity. How, in your lifetime, how many years do you think this pizza parlor is going to survive? Maybe 30 to 50 years, people will be eating pizza. Okay? Then you forecast forward. Of course, the further out you forecast, because of opportunity cost, the worth of the cash is less. Now, if you think that, hey, this area is, they're going to eat, because a lot of China immigrants, they're going to eat a lot of mala, hot pot, then the taste will change. Then next year it's going to be 80,000, then 60,000 profit. That you would not be paying 15 times PE, right? You'll be paying like 5 times terminal risk, 4 times PE, and that's it. There lies the big problem, right? Earnings per share has to go up in order for the share price to go up. So Singapore, our stock market is on a green color. It hasn't really been going up, but the earnings per share has been growing up. But recently, due to the rally in the last 2 years, to 2.4 onwards to 2.5, a lot of it is some changes in the SGX ruling regarding Singapore Family Office to have some exposure into Singapore stocks. It's really begun to go up, and is, of course, the inflection point right now is above the earnings per share. So again, Singapore companies, a lot of cyclicals, a lot of GLCs, government-linked companies, not many tech companies. So the earnings per share growth isn't really the highest. So go where the fish is, where there's plenty of fish. I would dare say this is an indicator. There will always be stocks that buck the trend, but in this case, generally the index has outperformed the earnings per share, and I'll be careful. This is roughly out. Now, Japan has flown through the roof because of some corporate restructuring, and the Japanese government has become very activist in the way they actually encourage the Japanese companies to unravel their cross-holding. They used to have a lot of cross-holding. One company owns the share of the other, and the other. And why do they do that? Because they want to protect themselves from being taken over, and they are all cushy families that they know each other. So actually, if I own 20% of myself, my own company, and I own 20% of you, you own 20% of me, hey, I mean, then we just can fight off anybody, and we don't care. We just pay ourselves a high salary every year. Don't need to get pressured by the minority shareholders. All these have changed. So the government actually said that if your price to book is below 1, give me a plan, whether you pay out dividend, sell off your non-core assets, or buy back shares. Okay, have to have a plan. And because of that, it drove a lot of earnings. So those companies that actually reform and become friendly to minority shareholders, the keyword is friendly. if the company is not friendly to minority shareholders, forget it. You see, so Japanese stock market has rallied a lot. So has India. Is gone up a lot. Now, I'm sure you will agree with me that the Indian stock market is second to the US all these years. Very straight line. Earnings per share growth, the blue colored line has been the very consistently going up. And it's nothing to, when you might be wondering why is it that the economy is doing like 3-4% and the GDP, and then why are they growing so high? Because GDP is probably more of a measure of sales rather than earnings. So even if your sales is growing at about 4%, you can be more efficient, higher margins, and you can achieve earnings per share of about 10 to 12%. So over time, that is why the S&P 500 is doing 10 to 12% as well. Now, the second thing is, of course, the best quality companies want to get listed in the US because it is the creme de la creme, the strictest corporate governance. There's a lot of transparency. That's why even Singapore's best companies end up listed there. Like C Limited is listed in US, Grab is listed in the US. So, if you are listed, S&P 500 derives about 30 to 40% of their business revenue from overseas. So, in effect, S&P 500 is the MSCI world. It is not a reflection of US economy. Yeah, the yellow colored line is actually the stock index. It's also been sideways for a long time until recently it started to go up. And what led to it? The yellow colored line, you look at the blue colored forward earnings per share, it finally rose, right? It is very clear. Once you see that the company is rising in the earnings per share, it is a very good chance that the stock price will go up. Yeah. So then we talk about private credit question mark. So recently we have Blue Owl raising questions because they invested in a lot of shares. Okay, and private credit is actually invested into companies that otherwise cannot get access to the traditional bank lending. And I was a corporate banker for 3-4 years ago, and we don't lend to SaaS companies. And when you say 30 to 40% LTV on the loan, what is the asset value of SaaS? There's no real estate. It's just intellectual property, goodwill, cash flows, contracts. So recently we've seen a lot of the SaaS, the big ones, the bigger ones that got sold down. That also meant that, once the IP is impaired, the goodwill, there's question mark whether AI will disrupt the company, then everything comes tumbling. What if the contracts get terminated? So there's a lot of question on that. So it's with Blue Owl as well. I will not elaborate too much on what other private credit companies are involved, but the other vulnerable sectors, surprise, right, will be like healthcare clinic roll-ups. That means one doctor buys over many of the clinics using private equity loan. Now, this kind of thing, very hard to get a bank loan. Okay, again, back to my years as a corporate banker, very hard. You come up with an idea, I'm going to buy over 20 clinics for 10 million each. 20 clinics will mean I need like 200 million of loan. I only got 5 million. I just got a vision, and private equity will lend you on that. Now, once you become very highly geared, the clinics now are under your control. Roll up, that means it's a chain of clinics, dental practice or whatever. You are now under a lot of pressure to deliver, cut costs, streamline the business, a lot of cross referral. What if you can't meet the requirement? Okay, then the other one would be nursing homes. You'll be surprised, hospitals. And a lot of these hospitals, they may own the real estate. Private equity buys it up, strip out the real estate, sell it off, okay, to the REIT. They pocket the profit, and then after that, they roll up. What's left is a hospital or nursing home operator that is already very highly geared. And there is the question, okay, a lot of pressures have come about. So this year, what is it going to be? What are the top performers? I think industrials, materials, it may not be tech this year that's going to be performing. Asia, ex-China, emerging markets likely to perform. And banks, small mid-caps, and the banks are likely to outperform. Now, I'll explain a bit about industrial materials. Okay, this is an article courtesy of Contra Toto. Now, in this AI world, right, what are the layers of companies? There are 5 levels of companies that you invest in. Okay, start at level 1, ground zero, energy. You got GE, Vernova, Cameco, Corp, Constellation Energy. You definitely need it. There is actually no question mark about it. Energy is energy. It's not going to be disrupted. You're going to see a lot of companies, the demand actually go up, utilities going up. Level 1, chips, chip makers, the tool makers as well. So remember the gold rush in the 19th century, right? The gold speculators were buying picks and shovels. Who you back? Picks and shovel makers surely need to sell, right? The bullet makers or the armies, the speculators. Speculators, you only got a 10% chance of making it. So it's the picks and shovel makers, the bullet makers. So TSMC, NVIDIA, AMD, ASML, Broadcom. Level 2, infrastructure and data centers. Equinix, Arista Networks, Networks, Vertiv, Amazon, Google, Microsoft. These are the infrastructure builders. You definitely need them. Then level 3, AI foundation model companies. OpenAI, Anthropic, Google, DeepMind, Mistral. This is where it gets muddier and muddier. Yeah, data centers, you need to be located in places where the energy is abundant, okay, and electricity is cheap. So that there also you can be very muddy and getting more inconvenient. So as level 1 goes to level 3, it becomes muddier. The competition is tougher, right? So the bottleneck is now in energy. Data centers takes about 2 years to build up. Maybe the next 2 years, the supply will come on stream. And then the level 3 is competitive. Have you ever tried Perplexity? You can one AI model after another, and have you really paid for the AI model? So Perplexity allows me to pick from a lot of the AI models. In fact, I can choose Gemini, I can choose ChatGPT as well. Just pay Perplexity for it. So then level 4, it gets more and more competitive. AI software infrastructure, Amazon Web Services, Google Cloud Services, Microsoft Azure, Palantir, Snowflake, Databricks. And then finally level 5, AI applications right at the front end of the war zone. And that's why a lot of SaaS have corrected. Meta, Google, and Microsoft, Amazon, ServiceNow, Shopify. I do not think that those big companies like CRM, it's not a question of why they are down 50% because of existential reason. It's because a lot of these companies are forced to put into a lot of capex. Okay, so the free cash flow will tumble. Free cash flow tumble. When are they going to get it back? There's no guarantee any of these capex is going to result in higher earnings, for right? So because of this, right, dropping earnings, and then the growth may slow down because everybody is eating dog eat dog world, right? Microsoft Dynamics 365 is going to fight with Salesforce. Everybody is doing agentic AI. Will you actually recoup your cost? So the fight is in the SaaS side. The ROI is unknown. And because of that, a company that used to trade that 40 times PE, because it justified 30% growth, I'm talking about just rule of thumb 1.5 times PE to growth ratio, yeah? Now, you may be looking at only 10% growth. So is 40 times justifiable? It should be at 15 to 20 times max, right? PE, right? So there lies a big tumble in Adobe. There's a big tumble in CRM. You cannot use Wall Street forecast. You have to use your common sense. Are they ever going to grow like that? Okay. Some of the SaaS, like there's a company called Text SA. They are the ubiquitous help desk. The little thing that pop out. They give up. The stock price has tumbled over 50%. They run out of money to do any AI enhancement. And if you give up the ghost, what do? You give out everything by dividends or you buy back shares. But if the company doesn't have a future, it's stupid to buy back shares. There's some stories of case studies of companies in the US that eventually went bankrupt. One is a retailer company. I cannot remember. But once you keep buying back the shares, it doesn't make sense. So in a company that is going to wind up, better pay off dividends. So a lot of the tech companies are showing that direction. So again, I'm not saying that they are all going to go bust. Do I think that they're all going to go V-shaped recovery? No, things are changing. You never know, okay? Right now, AI still have hallucination. Okay, that means they come out with data that answers their probabilistic and be wrong. But 5 years down the road, you have general artificial intelligence, GAI, you're going to get the ability to reason, okay? And that could mean further disruption. So the competition is going to get tougher, it's not going to get easier. And if the West don't do it, China will do it as well. Okay, they have a lot of resources going to it. So I'm going to talk about the edge. When you are investing, there has to be an edge to why you're investing, and you need to know more. I always feel that intelligence, second level derivative thinking, third level is very important. First level means, oh, interest rate goes down, bond price go up, everyone knows about it, right? Second level, second stage derivative thinking is that what happens if interest rate go up, stock price interest rate goes down, stock price goes up. Will it lead to inflation? And then among the stock market, what are the sectors that are likely to go up? Is it the inflationary event? There will be cyclicals, commodities that are going up. Third level thinking is, what's the longer picture? Are we in for a low interest rate environment? And if that's the case, will gold and silver go up? And people who are very successful investing think about that in the third layer. And also the other thing is inverse thinking by Charlie Munger. Think about what can go wrong and then take steps to prevent it from happening, right? For example, when you invest in a fund or you invest in someone, the worst thing that can happen is inverse thinking. What's the worst thing? Permanent loss. You cannot deal with temporary volatility. It's fine. Okay, as long as it goes down, goes up, it goes higher, it's fine. Okay, you can do 10%. Of course, you want lower volatility and constantly up. The worst thing is permanent loss. Permanent loss, so if you buy a high yield bond, you like to buy bonds, ask yourself, are they highly geared? Is the management willing to pay the integrity, the business? Is it able to pay off the interest? And the worst thing is permanent loss. So how to avoid permanent loss? Speculative bonds that pay 7 to 8%, forget it. Don't buy that. Buy it in a fund. Do not buy in a bond. Yeah, individual bond means that you need about 10 to diversify. And then if one blows up, 10% loss, can you take it? Right? So inverse thinking, if you buy a hedge fund, go for those that are lowly geared, very highly regulated. The lower the gear, the greater the transparency, the better it is. So these are the things that inverse thinking, right? Think about what you can lose. And that concludes special sauce. So that's the end of this part of the macro outlook.